Coming off of two big Mondays in a row, do you think Merger Monday is here to stay?
You know, I don't know if it's here to stay, but I certainly hope so. It's been a challenging M&A market, especially when you consider the strong fundamentals. Companies looking to grow, having record amounts of cash on hand, credit being pretty solid, at least for middle-sized deals, and you know, organizations feeling more confident than ever. We just completed our Capital Confidence Barometer study, and over 1,000 C-suite executives around the world, and they're feeling more confident about deal making today than tomorrow. So I don't know if Monday's a trend, but certainly reasons for optimism, which are sort of bucking the economic environment today. You know, it's gotten very difficult to predict the short term, but I think medium to long term should play out well for M&A because of the strong fundamentals that I just made reference to, and because people want to do deals. They're looking to grow the top line. Organic growth's become more challenging, although it remains a priority focus for the board. Companies want to grow through deal making. So tough to predict quarter over quarter, but medium term I think bodes well for deal making, and companies are better positioned, and the boardrooms are more ready to do deals than at any time over the last 3 years, you know, from the results of our survey. So I think, you know, the outlook for M&A remains, you know, cautiously optimistic. I think we have to figure out where the economy is going, the role of government and public policy to remove some of the uncertainty that's held it back a little bit here in the short term. You know, deal making is really a function of what we call the 3 C's: capital, cash, credit, and confidence. And your cash is pretty good. I mean, you have over $2 trillion of cash on corporate balance sheets today. You know, at least $500 billion in private equity coffers waiting to be invested. The dry powder there is robust. Credit's pretty solid. Could be a little better, but certainly when you compare it to, you know, 2008, 2009, and much better. I think the big unknown is the C in confidence. And we also expect to see, you know, a significant level of activity around divestitures. It's been divestitures at their highest level that they've been in 18 months, and you know, I think it's been driven by a number of primary issues. One, companies sort of undoing the big mega deals of the middle part of last decade, so shedding non-core, underperforming assets. Two, they're looking at divestitures as a way to free up capital, potentially to do other deal making, which is why we think divestitures potentially is a good sign for increased M&A activity. And then I think third, we've seen a lot of divestiture activity around shareholder value. So there have been a lot of big mega deals on, you know, divestiture, spin-outs, carve-outs, all about maximizing shareholder value, the sum of the parts being greater than the whole. You know, I think the size of the deal is all about the kind of value that can be created, and those who have vision, particularly in industries that are undergoing transformation and have access to the right amount of capital, will do mega deals. Expect to see continued increase in divestiture activity. I think there's a rationalization going on in corporate America today to optimize balance sheet performance, create value for their shareholders, and I think that'll be the leading indicator or headliner, certainly in M&A for the near term. I also think you'll see deals, you know, continue to see deals, inbound deals from China, particularly focused around the energy sector. You know, those are not the kinds of deals that are getting a lot of attention today, but I expect to see more of that.